Hey everyone, welcome back to Corporate Decoder. Today TFX just filed an 8K and it looks like they are refinancing some debt. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is taking out new loans to pay off old ones, and that can tell us a lot about their financial health and future plans. Teleflex Incorporated, ticker symbol TFX, announced a significant move in their financing strategy on the 1st of June 2026. They priced a private offering for about $500 million worth of new senior notes that are due in 2032. These new notes come with a coupon rate of 5.875%. What does that mean? It means Teleflex will have to pay 5.875% interest on this new debt each year until 2032. The money from selling these notes is intended to pay off their existing 4.625% senior notes that are due in 2027. Essentially, they are swapping out older, smaller debt for newer, larger debt, and at a higher interest rate. The intention is to use these proceeds to call back or redeem all of their existing 2027 notes. This suggests Teleflex might be looking to manage its debt maturity schedule, or perhaps they believe the terms of the new notes are more favorable in the long run. Even with the higher interest rate, the closing of this offering is expected around mid-June. It is important to note that these new notes are being offered in a private sale. This means they are not being sold to the general public through a stock exchange. Instead, they are being offered to specific types of investors, like qualified institutional buyers in the US and certain non-US persons. This is a common practice for large debt offerings, usually done under the idea that these sophisticated investors can assess the risks involved without the full registration process required for public offerings. This filing is essentially an announcement about the pricing of the notes, not a direct offer to buy or sell them. It also clarifies that this report is not a notice for redeeming the old notes, but rather a heads up about the transaction. The company attached a press release detailing this announcement as an exhibit. This is where you would find the official word from Teleflex about this financing deal. Looking at Teleflex's overall financial picture, they are a player in the healthcare and medical instruments sector. With a market cap around $5.9 billion and a current stock price nearing $128, they are a substantial company. However, their P/BA ratio is quite high at over 2200, which often suggests investors have high expectations for future growth, or that earnings are currently depressed. The news about refinancing debt is interesting in this context. Companies typically do this when they want to lower their interest costs, extend their repayment periods, or free up cash. In this case, they are increasing the interest rate from 4.625% to 5.875%, which means their annual interest payments will go up. Why would they do this? One reason could be that the 2027 notes were coming due soon and they wanted to lock in financing for a longer period. Another possibility is that market conditions for issuing debt have changed, and this is the best rate they could get for the term they need. It could also be about managing their overall debt structure, perhaps consolidating debt or preparing for future investments or acquisitions. The fact that they are issuing $500 million in new debt to pay off an unspecified amount of the 2027 notes implies they might be taking on more debt overall. Or perhaps the 2027 notes were for an amount less than $500 million, and the excess will be used for other corporate purposes, or simply increase cash on hand. Teleflex has significant institutional backing, with BlackRock and Janus Henderson holding substantial stakes. These large investors typically do their homework, so their continued ownership suggests they see value in the company. However, high debt levels, especially when accompanied by rising interest rates, can be a drag on profitability and financial flexibility. The most interesting takeaway here is the decision to refinance at a higher interest rate. This isn't typically a sign of extreme financial strength, but rather a strategic decision to manage liabilities. We'll have to see how this impacts their future earnings and cash flow. Servicing this higher debt load could become more challenging. Conversely, if they can grow their revenues and profits sufficiently, this move could position them well for the next decade. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives.